The MBA Research and Curriculum Center and NOCTI have collaborated on this microcredential. This microcredential explains financial modeling and is divided into 4 targeted skills. This targeted skill explains components of income statements. Income statements summarize the flow of money in a business, where it comes from and where it goes. Income statements show income and expenses over a span of time, such as 1 year. Income statements show 5 main financial components: revenue, cost of goods sold, cost of sales, gross profit, operating expenses, and net income or profit. Revenue is the total amount of money a business earns from all sources. Sales, earned interest, and services are all sources of revenue. For example, the U.S. Postal Service sells stamps and mailing items, but also sells services such as overnight delivery and priority mail, all of which bring in revenue. Cost of goods and sales reflect the direct cost to buy or produce the product that a business sells. Items such as raw materials, labor, supplies, manufacturing overhead, and unsold or returned items are considered costs. For a delivery service, investments in new package processing equipment support the services they provide. Gross profit simply is the total sum after subtracting the cost of goods sold from the revenue without considering operating expenses. Gross profit helps business owners compare the amount required to make or obtain the products against the costs of running the business. If a company's overall revenue is $500,000 and the cost of goods sold is $400,000, then the gross profit is $100,000. Operating expenses include all expenses associated with business operations. These include wages and salaries, insurance, utilities, vehicles, rent, mortgage, interest on loans, and administrative costs. These expenses can be variable, like interest, or fixed, like rent. If a company owns vehicles, the cost of maintaining the vehicles becomes an operating expense associated with operations. Net income is the final profit after all expenses are deducted from gross profit. This figure determines whether a business is profitable. Net income equals the profit or earnings. For some organizations like nonprofits, it is not advantageous to show a profit, as this may discourage contributions to a charitable cause. Organizations like the United Way, Big Brothers Big Sisters, and American Cancer Society are familiar nonprofits. Income statements show a coherent summary of a company's finances in a logical manner, including revenue, costs, gross profit, operating expenses, and net income.